Hello, everyone. Today on the Final Bar, I'm talking with Craig Johnson of Piper Sandler in Minneapolis. We'll see what charts he is showing to his institutional clients, which groups and names are on the move that are on his radar. We'll talk about this overall environment. Another choppy day. The S&P pretty close to unchanged, but a lot of movement underneath the hood. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the Technical Analysis Toolkit. I was taught many, many moons ago that technical analysis is really valuable for helping you quantify investor psychology. I did a lecture yesterday a couple times for students at Babson in the Boston area. Was talking with them about just the idea of getting inside the head of other investors and focusing on the fear and greed, the emotional motivators that cause people to pull the trigger and buy and sell stocks, and how charts can help you quantify and aggregate sort of that collective emotion and start to figure out when things are shifting. And arguably, we're in that sort of environment where the major benchmarks are sort of sideways, right? If you look at where the S&P is now versus 10 to 12 months ago, not far off. Although there's been a lot of movement along the way, it's been a sideways move. However, if you look at certain groups, if you look at a group like homebuilders, you look at some of the stocks and names we'll talk in our market recap, some of the ones we'll discuss with our guest today, Craig Johnson, you find there's plenty of movement happening. You just need to know where to find those. And that's where, again, I think charts can be really helpful to help you improve your situational awareness to better appreciate and understand where the opportunities may be. With that in mind, let's get started with our market recap. Start looking at what happened in the S&P and the NASDAQ and the other major averages today. A lot of unchanged-ish kind of numbers, what I'm looking here, to be honest with you. And what's interesting is this is an earnings season. We're kind of getting into the meat of it here. This is sort of the beginning of a number of weeks where you have a heavy earnings reporting every day. As we're going live here, we have things like Tesla, some, pretty important names kind of coming out. We'll do our best to stay on top of all of those and look at how we are reacting or how the markets are sort of anticipating and reacting to those numbers. But at the end of the day, what's interesting to me is even with all the movements that we're going to highlight, the S&P not far off, a couple pennies away from where it was yesterday. So we closed just below 41.55. The NASDAQ composite, again, also flat, and the Dow down about 0.25%. So overall, not much change from yesterday's close. Small caps actually led the way higher, but not by much, under 0.33%. So interesting that we've seen small caps underperforming for quite some time. Today, again, one day only, but you're getting small caps up while the rest of the major averages essentially are flat. Wanted to point out just really quickly the VIX, which is continuing to push lower. It's down about another 50 basis points to just below 16.4. This is the lowest the VIX has been in quite some time. We'll look at a chart of that in a few moments here, and you'll see what I mean. We're back to what I would describe as very much a low volatility environment. Reminds me a lot of like 2021, which is a sort of consistent, slow and steady uptrend with minimal volatility, minimal drawdowns, to be honest with you, right? The deepest drawdown in 2021 was like 3 to 5% probably. And compare that to 2022, obviously a much more different environment. The VIX is telling us we're more of a 21 versus a 22 in terms of the volatility characteristics. We'll look at those charts here in a few moments. Looking at interest rates, fixed income markets, currencies here very briefly. For the most part, the yield curve went higher today, although the short end of the yield curve came off a little bit. The middle point, sort of longer point, 10-year yield, right around 3.60 or 3.6%. And that's up a bit from where we were yesterday. Across the board, for the most part, rates moved a little bit higher. The dollar index up, but not by much, about 0.25%, and that's using the UUP. When I'm looking at commodities, mostly red, although silver, the SLV ETF was up about 0.33%. Gold actually down about 0.5%. That's using the GLD. And for the most part, you're seeing commodities moving lower. Energy was actually one of the worst performing out of the 11 S&P sectors today. Materials down as well, about 0.25%. Cryptocurrencies all in the red. What's interesting about this is we've been talking about sort of this bull phase, this new raging bull market in cryptocurrencies, with Bitcoin pushing well above 30,000, Ethereum getting above 2,000. All the rest of these seem to be hitting key resistance levels and then breaking through them. Today, more of a risk-off feel, certainly with cryptocurrencies. Bitcoin is down about 4%, Ether down 6%. And you can see the others. Again, the top 10 coins that we track on our StockCharts platform, all in the red today. Let's look at some of the charts that put a little more detail behind what we talked about. Then we'll look at some sectors and names to highlight before we get to our break. Looking at the daily chart of the S&P 500, I don't think much of a change, literally not much of a change in terms of the directional move of the S&P from 2 days ago to yesterday to today. Although, again, you're seeing a lot of individual names that are moving. I think the same levels still very much hold. The question mark that I would put on this chart is which of these things is going to happen, right? Are we going to get above 4,200, push toward the August 22 highs around 4,300, maybe even eclipse those and push onward? A lot of individual stocks, by the way, you're looking at the February highs. Many of them have eclipsed their February highs. Some of those, just currently, right, when you're looking at some names in technology and consumer and healthcare, you're seeing them sort of, break above homebuilders, right, sort of testing their February highs and many of them breaking above there. Can they get above the August high, which is sort of the most significant high we've seen previously, sort of in the third and fourth quarter? Or do we draw down a little bit? Do we pull back and get below 4,100 again? That 4,100 level was key. It's that blue shaded area that you see here. We first tested it at the end of November, beginning of December. We then broke above it in February, but really didn't follow through at all. It sort of like went above, closed above one more day, and then that was it. We sort of reverted back lower, back below 4,100 soon after. This is yet another attempt to get above 4,100 and stay there. And again, I think the proof is in the price. As long as the price remains strong, as long as some of the names that we're going to talk about, the individual stocks and groups that are showing strength, continue to show strength. I think the likelihood certainly is that we could see further upside. But again, 4,100 sort of a nice level to set an alert, for example, and just make sure as long as we stay above there, things are actually probably pretty decent. We get below 4,100, I would start to question a little bit about the sustainability of this up move. Think about some downside targets, some of the moving averages and other levels that may provide some potential support levels. But for now, hanging in there just fine. Wanted to look briefly at the Mindful Investor Live chart list. Again, this is a list of charts that I keep updated on the StockCharts platform. You can get to it from my blog, which is called The Mindful Investor. If you go to the articles tab at the top of our website, I just want to go through a couple of these that I think are worth highlighting. We'll start with this one. This is looking at the percent of stocks above their 50-day moving average and above their 200-day. In blue, that first panel below the price is the percent above their 200-day. And this is just looking at the S&P 500. You can see it's currently around 63%. Below that, we can see the percent of S&P members above their 50-day moving average, currently around 59%. What's so interesting, and I don't disagree with the general argument that the overall strength that we've seen in the benchmarks, I think fair to say that it's been driven in no small part by the strength in the mega cap trade, right? The FANG stocks, or what we call the Phenomena stocks, right? Meta, Microsoft, Apple, sort of names, right, that have shown a resilience, and others like semiconductors, NVIDIA, and others. Big mega cap names that have been so strong. And if you look at the year-to-date returns of that group of 5 to 8 stocks versus the average return in the S&P, look more like an equal-weighted S&P, big disparity between the two. However, right, looking at a breadth indicator like this, I don't think you can say it's a narrow market or a narrow bull market when 60%, 59% of the S&P stocks are above their 50-day, when 2/3 almost are above their 200-day moving average. That might not be the best charts you've ever seen, but they're certainly not bad charts. And I think that is what we've sort of recognized is that the strength that has been led by those mega cap names that really have the ability to move the benchmark higher. You're also getting some participation, a little broader participation underneath the hood. I'm not struggling to find stocks that are not just testing resistance, but actually breaking through them. I think that might be pretty key. The next chart I want to show with you is the VIX. We talked about volatility, and we're looking at just the last 2 years here. You can see where we were sort of early to mid 2021. The VIX was ranging from around 15 on the lower end to around 20, 25 on the upper end. You see a series of spikes up to like the 23, 25 plus range. Look at how different the VIX was in 2022 up until really the October low. You saw the VIX elevated, right? Rarely got below 20, often got above 30, even up to 35 plus. on those big spikes. So look at how the entire range became elevated. Now what we've seen in the last 6 months is the entire volatility, the VIX, sort of what I call volatility regime, has come down a little bit, kind of ranging between 1920 to 25. Now we're actually going to a new low. We're at the lowest level we've been since the end of 2021. So once again, we're sort of in this sort of slow and steady, low volatility environment, which all of a sudden makes this recovery off the October lows look a lot like sort of early 2021, where you had this nice uptrend with minimal drawdowns and low volatility. What would tell me that that is not what we're seeing? Very simply, volatility stops going down. It's going down big time, right? From 26 in mid-March to almost 16 now in mid-April. And the market stops going up. And until those things change overall, I'm seeing the market higher on lower volatility. That's kind of a nice sort of bull market setup to be had. Last thing I want to show you is offense over defense. This is a chart we refer to pretty often. It's looking at the XLY, consumer discretionary, versus XLP, the consumer staples. And we have the equal weighted version of the ratio using equal weighted ETFs down at the bottom there. You can see that these have been trending downwards since February. That's when the market peaked there. So even though the S&P is rotating higher, sort of threatening to overtake 4,200, these measures of offense versus defense still sort of in a bit of a downtrend. So can the market go higher with this ratio going lower? Of course, and you've actually seen it here in the last couple weeks. Would I feel much more encouraged about the potential for further upside if those ratios turn higher? Absolutely. Folks, let's take a quick commercial break. We'll be back with today's guest, Craig Johnson of Piper Sandler. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. It's such a pleasure to do this show for you, and it's great to see you here on StockCharts TV. Thanks for joining us every weekday after the close for the Final Bar. Couple quick announcements before we bring on today's guest, Craig Johnson. First off, we welcome your questions. We do a mailbag segment a couple times a week. We're going to do one this Friday, and we'd love to answer your question live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv, and we are on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We would love to hear from you and hope to answer your question live on the air on Friday's show. Upcoming guests, we have Dan Russo of Potomac Funds. Dan actually used to host a weekly show on StockCharts TV, which we absolutely really loved, and many of you enjoyed. We're excited to have Dan back as a guest tomorrow, coming to us from the New York area. Next week, I will be heading to New York, seeing our guest today, Craig Johnson, and many, many others in the CMT community, getting together to celebrate the 50th anniversary of the CMT Association. Tom Boley of Earnings Beats has agreed to guest host the show Monday, Tuesday, Wednesday, Thursday, and then Friday, April 28th, we will be coming to you live from the stage at the CMT Symposium. We have two really fantastic guests. Ralph Acampora, the godfather of technical analysis, Louise Yamada, one of the most long-standing, incredibly talented technical analysts, both coming to us, having a conversation about the market environment, how they compare what they're seeing now versus other periods that they were actually investing in and found success during. Should be a lot of fun, so make sure you tune in next Friday, April 28th. It'll be a little earlier. It'll be 1 o'clock Eastern. We'll replay it later in the day for you as well. Want to bring on today's guest, Craig Johnson. Craig is the Chief Market Technician at Piper Sandler, coming to us from the Minneapolis area. Craig and I served on the board of the MTA, now the CMT Association, a couple years ago. Craig, great to see you. Welcome back to the show.
Thank you, Dave, for having me back on, and it's always a pleasure to be on the show.
I feel like every time we have you on, there's no shortage of charts we could look at. And even when we were talking before the show, we went through about 100 of them. I feel like just going through different things. Let's start at the high level and let us see and understand where you're coming from when you're looking at the market environment. We're starting with your chart of some of the major averages in the U.S. What are you seeing here?
You know, Dave, so there's just a tremendous amount of negativity. I've been having conversations post our most recent monthly publication that we put out, and I just try to step back and simplify. And when I do that, I pull up a chart of the Dow, the S&P, the Russell, the NASDAQ Composite, and even the Transportation Index. And it's like very clear. We've reversed downtrends off of the highs. We have even seen where I put these little gold bars in, Dave, where we've got golden crossovers of 50-day moving averages back above 200-day moving averages on all of these indices. So if anybody's trying to discuss this market in some form of a relief rally, it's not what we got. The intermediate term trend is turning higher, and it's happening not just with a index, it's happening with the broader averages and the popular averages across the board. So I think this is a good sign. And I think it's a bullish sign for the market. It's just so many people are tripped up over the headlines out here, Dave, right now. And I think if we got to put it all together into one line, we got to focus on the trend lines over the headlines right now, because that's really what's going to help us.
Ooh, I love that way. There's a lot of quotable moments in there that you just described. And looking at these indexes on a closing basis, you see this clear rotation, which I feel like we get so caught up in the short term, the flickering ticks. At the end of the day, great to see that medium term rotation from downtrend to uptrend. Well put and well illustrated. Here's your daily chart of the S&P. What does this do, or what does this tell you?
Well, stepping into a little bit shorter term window in here, if we just start looking at what the Godfather has taught us all over the years, Ralph Acampora, just focusing on price. When you start making higher highs, higher lows on price, you can see this emerging uptrend channel that has been forming in here. You can even see that you've got a 20-day, which is a little gray line in there, moving above a 50-day moving average, and your 50-day moving average is already above your 200-day. So again, anybody that's looking at charts is going to be recognizing that the low was made in October. You're now in an uptrend, and we're next going to be challenging those February highs right around that 4,200 level. And then ultimately, perhaps going back and challenging the highs we had seen back in August of 2022. Dave, I'd also just note that you've got your 50-day moving average, your percent of stocks back above your 50-day and 200-day continuing to grow again. I think that's a great sign. I'd like to also mix that together with a 14-period RSI, which will help me determine sort of an overbought versus oversold condition. And right now, it doesn't look like we're overbought. We're just kind of slowly grinding higher. And I think the point you made on the VIX, Dave, is absolutely terrific. The volatility is coming down, and that's the fear gauge in the market. It's coming down at this point in time, and you're seeing a lot of the right pieces come together. But investors need to get through this next couple weeks in terms of earnings to feel better about the market. And I think once we get through another week or two and we see that earnings aren't going to fall apart, I think the market's going to probably quickly move through that 4,200 level, which I think is a massive psychological level. And by the way, when you look at some of the CFTC data, Commitment to Traders Report data, it is as negative today as it has been back in 2007 and 11. And I think everybody's going to find themselves sort of off guard, and you're going to see the market continue to grind higher. That's all the pieces that I'm putting together, Dave, as I'm looking at sort of the picture of the market right now.
That's super helpful, Craig. And I love how you illustrated this uptrend channel. By that definition, we're kind of at the midpoint of this uptrend channel, which has been really coming off of the October lows. Let's look at some of the other asset classes, because I think now more than ever, we're recognizing the importance of intermarket analysis, thinking about how all these different assets are related to one another. Talk to us about the dollar, particularly the weakening of the dollar, what that means for the rest of the market for risk assets.
Dave, you're exactly right. And John Murphy was a pioneer of looking at a lot of that intermarket analysis, and certainly respect all the work that he has done over the years. Looking at the dollar, no question, trend is lower at this point in time, and you're below a declining 50 and 200-day moving average right now. I think if there was a lot of fear building, lots of concern building, I'd be watching the dollar going up. That is your defensive trade, historically speaking. And right now, that's trending lower, and it has been since the October timeframe. And from my perspective, the weaker dollar is a sign that this market can continue to keep grinding higher in here.
Yeah, the strong dollar certainly killed a lot of risk assets last year. You're seeing the opposite now, right? Weaker dollar sort of gives room for some of these other assets to work. What about interest rates? What's your latest thinking there?
Interest rates are this is going to be the most interesting sort of trend change that we have seen. When you go back and you look at a long-term chart going all the way back to the early 1980s, late 1970s, we have seen a 40-plus year downtrend reversal. Don't forget that long-term secular change is what I remind people, because the pullback that you've seen from a little over the 4% 10-year bond level to where we are now is nothing more than a check-back rally. And I think that is going to be a move that'll probably take us closer to maybe 275, 3% range ultimately before this sort of runs out of steam. It's going to go down at kind of a slow pace, Dave. It's not going to happen all overnight. but I think it is trending lower. That is adding to sort of the risk on environment to a degree. It is also providing some comfort to investors and portfolio managers that the Fed is doing their job and that we are seeing the inflationary pressures coming down. And again, I think that's adding a little bit more confidence for investors out there. But again, the trend is lower at this point in time, and that will ultimately underpin and support the risk assets.
Really, really interesting. I'm on StockCharts. We have a historical chart gallery with some really long-term charts. We have the 30-year Treasury yield back to 1940, and it's this clear uptrend, 1940 to 1980, clear downtrend, 1980 to about a couple years ago, and then all of a sudden this big rotation. And I think 100% agreed. Recognizing that sort of bigger secular shift is kind of an important lesson to think about, certainly to think about market history in a different lens. Let's talk about crude oil here. Crude oil gapped higher on news in the last couple of weeks. What do you see now going forward?
Yeah, I mean, that gap up was driven by OPEC Plus cutting production. Fascinating, though, that we ran right up to the 200-day moving average, a declining 200-day moving average, might I add. And all we've done is sort of stall out. You can't get through that declining 200-day moving average. We're probably going to re-enter this downward trending price channel is what I suspect is going to happen. If you look at momentum on RSI at the bottom of the page, you sort of got to a slight close to an overbought condition, and now you're breaking the uptrend that had been in here. And I'll be sort of watching that midpoint at about 50 to see if that is going to be truly a definitional change in terms of trend and momentum there. But from my perspective, I think the lower oil price is ultimately a good sign that the Fed's activities are working. Those inflationary pressures are easing. And I think, again, that should be supportive of equities continuing to move higher. That being said, a lot of people have asked me, Craig, why do you still remain to be overweight the energy sector at this point in time if oil prices are going lower? Well, the answer is I see good opportunities inside of the services companies. I see some pretty good opportunities in some of the drillers at this point. And when I look at a total return relative strength of energy, it looks like the uptrend is still intact. And we're just sort of backing and filling at this point in time in that relative strength trend. So I still think it makes sense to be overweight energy. It makes sense to be overweight industrials and also technology, which we just recently upgraded, Dave, to a overweight position.
Interesting. Let's talk about a couple of names and groups if we could. If we want to start with technology, one of the few places that I think has been incredibly resilient, the semiconductor space, right? NVIDIA, probably the most widely known name, but a lot of others as well. Semiconductors, still a good idea here? Is this the kind of trend that you would think would continue to work? Or what would be your exit strategy? What would be the sign that something like this is no longer an ideal chart?
Yeah, so I still think the semiconductors are ideal at this point in time. If I look at a chart, Dave, like the SMH that you're bringing up, which is going to be a ETF, the Van Eck ETF of this, I don't have a breakdown here. You look coming off those October lows, you draw your trend line coming up. That uptrend still looks to be intact. You might have a little bit of momentum sort of checking back to the midpoint at this point in time, but I wouldn't say you have clear evidence of any sort of real breakdown at this point in time. There is a school of thinking out there among some of the institutional crowd that maybe you should take some profits in SMH and maybe you move over to the IGV, which would be your software group. But at this point in time, again, I think both look fairly constructive. You do have a little bit of profit taking in SMH, but not enough to say, hey, we need to rotate today. But they are starting to see a catch up in some of these software names out here at this point in time. So I think having a pretty good exposure to both semiconductors and semis inside of your technology holdings is probably a good balance between the two. Probably makes the most sense in terms of the trend and relative strength work that we're seeing today.
Thanks for highlighting the software group. This is IGV, which is an ETF, an iShares ETF we were talking about that shows that rotation. It's so interesting. Technology is such a catch-all for so many different types of business. I feel like at some point that might be a bunch of different sectors. But for now, all of these at the same point. But you're right. Software really starting to improve. Can we talk about homebuilders briefly? Because that's a group certainly that's come into a lot of strength here recently. And not a lot of these names reporting earnings recently, testing new swing highs. This is DR Horton. We could look at an ETF like ITB. What do you think about the homebuilder space here?
Well, there's a couple things when I think about these. If we look at DHI looks decent. You're above your rising 50, 200-day moving averages. Momentum still seems to be pretty good. But also take a look at Pulte, too, or Toll Brothers. I mean, it's not just one stock in here that's doing well. And you look at the fact that you're making 52-week new highs in things like Pulte. Like, I get it. There's challenges. There's discussion about the economy slowing down, but home builders don't seem to be reflecting that at this point in time. And one of the biggest concerns out there among a lot of the fundamental strategists across Wall Street is that if housing is going to have to roll over, when that rolls over, the economy is going to roll over. And right now, there doesn't appear to be any sort of rollover in housing, even with the higher interest rates out there. And perhaps the school of thinking of the way that lumber prices have come down, Dave, is sort of mitigating the pain of some of those higher interest rates that have gone up. And therefore, they're still finding a risk reward and a value proposition to be building the homes. Not to mention, you're probably a million and a half homes short post the pandemic and post the other financial crisis that we had back in 2007, 8, and 9. But all these look good. It's not just one stock here. It's all of them. The whole group looks good.
At the end of the day, what's most important is price moving higher, right, Craig? We need to wrap, Craig. Listen, it's awesome to see you. Thanks so much for sharing some charts. Thanks for sharing some investment wisdom with us. And we'll see you soon in New York, all right?
Thank you, Dave. Thanks for having me on.
That's Craig Johnson. Craig's the chief market technician at Piper Sandler. He and his group have published the book he mentioned at the beginning of our discussion called The Informed Investor. They've published this for years and years. It is incredibly valuable, and they have a whole strategy called the microgroup strategy. And what I loved about Craig and his work and his team's work for years is it focuses not on why something should work or what should happen. It focuses on the evidence, what is working, and lets you focus on strength and lean away from weakness. I think there's a lot of wisdom to that sort of approach. Great take there, as always, from Craig Johnson at Piper Sandler. We've got to go to the 3 and 3, folks. 3 charts in a little less than 3 minutes, but let's get to it. Chart number 1. Cisco, right? We talk about stocks in the news and stocks on the move. I love that our dashboard is able to focus in on names that are moving to the upside and the downside, help you think about some of the actionable movements that you need to be aware of. Cisco is one of those stocks that just gapped below its 50-day moving average. So up until yesterday, this is sort of a long and strong looking type of chart, right? Consistent new highs, new swing highs, higher lows. This all of a sudden starts to change things, right? And an ascending 50-day moving average is often a pretty good pullback level. Now we've gapped below it a little bit. Looking at those February, March lows right around 48, we hit there today at the close. Does that support level hold? I think that might be an important chart to watch. Chart number 2, if that's a name moving down, Cisco, let's talk about a name moving higher in the healthcare space. A lot of stocks making new swing highs. Medtronic is a medical equipment name closing above its 200-day moving average. For the first time, really since February it did it, but really has been below its 200-day moving average since the fourth quarter of 2021. Finally getting back above that. If you draw a trend line connecting those highs, you'll see we're just breaking above it to the upside. I think that could be a compelling chart to watch. Other stocks within the healthcare space have already broken out. Something like Medtronic is actually breaking out after bouncing off of support just above $75 a share. Finally, I think the semiconductor space is really, really interesting. I was really glad to hear Craig's take on semiconductors. And I have to agree, right? Overall, the most bullish thing about a chart is its ability to continue higher. Higher highs, higher lows are all incredibly meaningful. When I'm looking at the chart of SMH, I'm looking at a potential bearish momentum divergence, which means the price is moving higher, the RSI is sloping downwards a little bit. To me, that's not an exit signal. That's not a sell signal. That just tells you to put it on a list and focus on what levels, what signal would confirm the fact that it's no longer going up. Until then, the trend remains strong as long as the highs and the lows keep getting higher. Folks, that's a wrap for this show, and thanks so much for joining us every weekday after the close for the final bar. All of our previous interviews are at StockChartsTV.com. Special thank you to Craig Johnson of Piper Sandler joining us from Minneapolis. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a good night. We'll see you tomorrow. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.